Assalamu alaikum warahmatullahi wabarakatuh.
The world of real estate investment, it feels like it's constantly shifting, doesn't it? You think you've got a handle on it, and then bang, new strategies pop up, old ones change. It can really feel like you're chasing a moving target sometimes.
Oh, absolutely. It really can. There's just so much information flying around, and figuring out what actually matters for your specific goals. That's the real challenge.
Exactly. And that's why we put together this deep dive. It's specifically for you, the learner. Our mission today is to cut through all that noise, navigate the complexity, and pull out the most vital insights from, well, a whole range of sources covering real estate today.
And we certainly covered a lot of ground. We looked into everything from, making sure your investments actually do some good, some social impact,
Okay.
to the real nuts and bolts of not overpaying for a property. We explored emerging markets. Oman came up as a really interesting case study. Clever ways to get your foot in the door without needing massive loans, and even breaking down the risk and return differences between things like REITs and owning property directly.
Yeah, absolutely. We also dug into diversification, why that's so powerful, what you might realistically expect in terms of returns for 2025, common mistakes beginners make, how to sidestep those, and even some really cutting-edge stuff that's reshaping the investment landscape.
So the goal here really is to give you a clear, solid understanding of the key things you need to consider in real estate right now. Those aha moments, hopefully, but without drowning you in data.
Perfect.
Okay.
So let's unpack this. Starting with that idea that investing in property can actually be about more than just the bottom line. It can contribute to the greater good, right?
Yeah.
That seems to be a growing theme.
It really is. There's definitely a growing awareness that real estate investment can and maybe should align with broader social benefits. This is where ESG principles come in: environmental, social, and governance.
ESG, right?
And when we zoom in on the social part, we're talking about really important stuff: affordable housing, how projects engage with the local community, creating places that are genuinely inclusive.
So it's not just, throwing up a building and opening for tenants. There are actual steps investors can take. What does that look like on the ground?
Yeah, there are definitely practical strategies. A big one is prioritizing affordable and inclusive housing. So maybe investing in mixed income developments or setting aside units for lower income households.
Okay.
Another key thing is actually talking to the local community during the planning stages, getting their input, understanding their needs, supporting local things like parks or community centers. That builds goodwill.
That makes sense. It's about being part of the fabric of the place.
Yeah.
And I guess sustainability fits in here too, green buildings.
Oh, absolutely. Investing in sustainable green buildings,
Yeah.
that's a win-win. It's good for society, healthier for residents, lower utility bills, but it also makes financial sense long-term. Think energy efficiency, maybe getting certifications like LED.
Right.
And it goes beyond the building itself. Investors can actively look at how a potential investment impacts the wider community. Is it near good schools, healthcare, public transport?
So you're looking at the whole picture, the surrounding environment.
Precisely. And supporting projects that revitalize neighborhoods, create shared spaces. That's another way to align investments with social good. And importantly, you need to actually measure this stuff.
Measure it. How?
Well, track the outcomes. How many affordable units did you create? What community programs did you support? It's about transparency and accountability, not just good intentions.
So it sounds like this social awareness is not just like charity. It can actually make the investment itself stronger over time.
That's a really key point. Thinking about these social factors, it can genuinely boost the long-term value, help manage risks. Having a good relationship with the community is a risk mitigator, and just build stronger connections with everyone involved, from residents to local government. It's about financial success and positive contribution.
Okay, investing with purpose. Got it. Now let's switch gears to something always top of mind. Making sure you get good value, that you don't end up overpaying. How do you nail that?
Right, this is where you need to be really analytical. The absolute foundation is doing a thorough, comparable market analysis, what people call comps.
Comps, okay.
You need to look at recent sales, say the last 3 to 6 months, for properties that are really similar to the one you're eyeing. Same neighborhood, crucial.
And it's more than just bedrooms and baths. Right?
Oh, way more. Square footage, lot size, the condition of the property, even how long those comps were on the market. If something sat unsold for ages, that's a red flag. Maybe overpriced initially. And you have to adjust. If a comp had a brand new kitchen and yours needs work, you factor that difference into your valuation. It's about getting as close to an apples to apples comparison as possible.
Okay, so comps give you a benchmark. But how do you really get the true value of the specific place you're looking at?
Beyond comps, you've got to look really hard at the property's current condition. Any repairs needed, outdated systems. That directly hits the value and should definitely shape your offer. Those online estimates, AVMs from Zillow, Redfin, places like that, they can be a starting point maybe. But you have to check them against real, local market data and, ideally, expert opinion. They don't know everything.
Good point.
And understand the market vibe. Is it a seller's market where prices are getting pushed up? Or a buyer's market where you might have more room to negotiate? That context is critical.
So it's data plus boots on the ground assessment.
Right.
What about the buyer side of things, the finances?
Setting a realistic budget and sticking to it is absolutely vital. Your budget needs to be based on what you can actually afford long term, not just the biggest loan the bank says you can get.
Affordability versus pre-approval. Big difference.
Huge difference. And you've got to resist getting sucked into bidding wars. Decide your absolute maximum price before you get emotional and be ready to walk away if it goes higher.
Easier said than done sometimes if you fall in love with a place.
I know. That's why the next step is crucial. Always get a professional home inspection. Seriously. A good inspector finds hidden problems, potential future costs, and you can use that information to negotiate the price down or get the seller to fix things before you close.
Makes sense.
And don't underestimate a good local real estate agent. They often know about sales that never even hit the public market. They understand the local quirks. Plus, good negotiation skills are worth their weight in gold.
So local expertise matters.
Yeah.
Anything else to keep in mind to avoid overpaying?
Yeah, keep a really close eye on interest rates and your financing terms. The purchase price is just one part of the cost, right? Your interest rate massively affects long-term affordability.
Yeah.
And finally, really try to keep emotion out of it. Base your offer on data, on logic. Ask yourself, if mine was the only offer, would I still pay this much? If the answer is no, maybe step back and rethink.
Really solid advice. Okay, now let's shift our gaze forward a bit. What are the big trends shaping real estate in 2025? We heard Oman is showing some interesting dynamics.
It really is, yeah. What we're seeing globally, and definitely in Oman, is that infrastructure, demographics, and government policies are really driving things.
How so?
Well, take Oman's Batina Governorate. They're doing major work, dualizing roads, improving ports. And as access gets better, what happens? Property values tend to go up, and it spurs new development. Classic pattern.
Right, infrastructure investment leading to value uplift. What else is happening there?
We're seeing rents rise and demand increase, especially for newer places with modern amenities. People want the new stuff, the better infrastructure. Plus, Oman's urban population is growing about 2.2%.
Okay.
And cities like Muscat, they're seeing a big influx of expats and professionals, like a 33% increase recently. That really pushes up demand for rentals in the good spots. And government policies like longer-term residency for investors are helping fuel that too.
So it sounds like Oman is actively trying to attract foreign investment in real estate.
Definitely. They've eased ownership rules for foreigners, offered tax incentives for developers, and it seems to be working. International buyers are showing more confidence, especially in luxury and mixed-use projects. The market's expanding.
Interesting.
We're also seeing a shift away from older housing areas towards these newer developments. Older places might see more vacancies, maybe even rent drops, while the new builds with modern features are much more attractive. Government incentives for new projects are helping that along too.
What about lifestyle changes? Are they playing a role? Like where people want to live?
Oh, for sure. Demand for coastal and waterfront properties is up. Developments that mix housing, shops, leisure right on the coast. Those are prime spots now. Think like the Yeti Sustainable Tourism City project.
Right.
And there's also this move towards urban decentralization growth happening more on the outskirts of cities, helped by better transport links, people spreading out a bit.
Makes sense.
And finally, a big focus on sustainable integrated communities, like Sultan Haytham City, green initiatives, community amenities, mixing residential with commercial and cultural spaces. That's a major trend globally. And Oman's embracing it too.
It really paints a picture of a dynamic market, especially in a place like Oman. Now, okay, for a lot of people wanting to get started, the big hurdle feels like needing tons of cash and huge loans. Is it actually possible to get into real estate without that?
Yes, absolutely. There are definitely ways for beginners to get involved that need much less upfront cash and don't rely on getting massive mortgages right away. You can learn the ropes without that huge financial pressure. Let's start with something called bird dogging.
Bird dogging? Okay, I like the name. What is it?
Think of, well, an actual bird dog finding birds for a hunter. In real estate, you are the bird dog. You find potential deals, maybe distressed properties, foreclosures, short sales, places needing work, or just sellers who are really motivated to sell fast.
Okay, so you sniff out the deals. Then what?
Then you connect that seller with an investor who might want to buy it. If your lead results in the investor buying the property, you get paid a finder's fee. Simple as that.
So you're like a matchmaker for off-market or undervalued properties? Are there catches, things to watch out for?
Well, yeah, some legal points. You can't pretend to be the owner, and you definitely can't act like a real estate agent if you aren't licensed. And no trespassing. But as long as you're just finding and passing on info, it's pretty low risk to start. The fee could be flat, or maybe a percentage.
Okay, that sounds very accessible. What's another low loan strategy?
Next up is wholesaling. This is a bit different. Here, you actually get a property under contract with the seller. But, and this is key, the contract needs an assignment clause.
Assignment clause, right. What does that do?
It gives you the legal right to transfer your position in that contract, your right to buy, to someone else before you actually close the deal with the original seller. So your goal is to find another investor who will pay more for the property than your contract price. You then assign the contract to them. They close the deal with the original seller, and you pocket the difference, minus maybe a small deposit you put down initially. You never actually own the property.
So you're flipping the contract, not the house itself. What skills do you need for that?
You need good networking to find buyers, a good eye for undervalued properties, and decent negotiation skills talking to both sellers and buyers. Knowing a bit about contracts in your local market helps a lot. The upfront cash is usually minimal, just that earnest money deposit.
Interesting. Okay, what about rent to own? Can beginners use that somehow?
Yeah, lease options or rent to own, that's another route. As the investor, you find an owner willing to do a lease option. You agree to rent their property for a set time, but you also get the exclusive right, the option, to buy it later at a price you agree on now.
Okay, so you control the property via a lease with an option to buy. Then what?
Then you find a tenant buyer, someone who wants to own but maybe needs time to fix their credit or save up. You rent the property to them for more than you're paying the owner. Plus, you usually collect an upfront option fee from them, which is non-refundable, and maybe keep a bit of their rent each month towards their future down payment. That's your profit.
So you're basically the middleman facilitating a future sale.
Yeah.
What are the perks for a beginner here?
Usually very little cash needed upfront. No need for bank loans or perfect credit yourself. You can get cash flow pretty quickly from the rent difference and the option fee. And there's generally less risk than owning directly. You can often do it part-time too.
Okay. Finding deals, flipping contracts, rent to own. What else is there for starting small?
Fractional ownership and crowdfunding have really opened things up. There are online platforms now where you can invest, relatively small amounts, sometimes just a few $100, maybe even less, into bigger real estate deals alongside lots of other people.
Yeah, I've seen those.
You own a piece of the property, but you don't have the landlord headaches. It's a great way to get diversification with limited capital. The key is just doing your homework on the platform itself. Check their fees, minimums, how easy it is to get your money out later, what their track record looks like.
Good way to dip your toe in. What about seller financing? Heard that mentioned too.
Yeah, seller financing is where the person selling the property basically acts like the bank for you. You agree on the price, interest rate, payment schedule directly with them. Often the down payment required can be much lower than a traditional bank loan.
When does that usually happen?
You see it more with sellers who are really motivated. Maybe the property needs work, or if the seller owns it free and clear, no mortgage. It takes negotiation, but it's definitely a way to buy without needing a bank involved initially.
Okay, and the last one for starting without big loans.
That would be real estate syndication. Basically, pooling your money with a group of other investors to buy bigger properties, like apartment buildings, shopping centers, things like that.
So group investing.
Exactly. There's usually a lead investor, the sponsor, who manages everything. The minimum investment might be higher than crowdfunding, but still way less than buying that big property yourself. And sometimes if you join a group or maybe offer specific skills to the sponsor, you might get in with less cash.
Wow, okay. It's actually quite amazing how many different ways there are to get started that don't necessarily mean taking out huge loans right off the bat.
Yeah.
Okay, let's shift gears again. Risk. Let's talk about risk levels and different approaches. How do things like REITs, real estate investment trusts, compared to actually owning property directly, risk-wise?
That's a really critical comparison, yeah. So REITs, because they usually trade like stocks on exchanges, tend to have higher price volatility. Their prices bounce around more with the general stock market and investor mood swings. You might see annual swings of, say, 17, 19%. They're also pretty sensitive to interest rate changes.
So more ups and downs in price.
Mhm.
What about direct property ownership? Less volatile.
Generally, yes. Direct property is less liquid, right? It's tied to a specific local market, so its price tends to move more slowly, maybe fluctuations around 5-6% for private funds, and it's a big open-do. But that lower volatility comes with much lower liquidity.
Meaning it's harder to sell quickly.
Exactly. Selling a building can take months, costs a lot in fees. REIT shares, you can usually buy or sell them pretty fast on the market.
Okay, so REITs, more liquid, but maybe more price swings short term. Direct equal less liquid, smoother price path, maybe? What about control?
Big difference there. With a REIT, you own shares, but you have zero direct control over the properties or how they're managed. You're trusting the professional managers.
Right.
Direct ownership, you're the boss, full control. You pick tenants, decide on repairs, manage the financing, but that also means you carry all the operational risks. Tenant nightmares, surprise roof leaks, that's on you.
And diversification, that seems like a big risk factor too.
Huge. REITs are usually diversified automatically. They own lots of properties, often different types of apartments, offices, warehouses, maybe in different places. That spreads the risk.
Whereas direct ownership,
Is usually concentrated. You own one building, maybe a few. So you're much more exposed if that specific local market takes a hit.
makes sense. What about how they're financed? Does that affect risk?
It does. REITs tend to be more conservative with debt, lower leverage, less reliance on variable rate loans. That makes them a bit less vulnerable if interest rates shoot up suddenly.
Okay.
Direct property investors often use higher leverage, maybe more variable rate debt to maximize returns. But that definitely increases the risk if rates go up or property values dip.
Okay, so REITs might have more price volatility, but maybe less debt risk structurally.
Yeah.
How does it all balance out when you look at risk versus potential return?
Well, interestingly, even with that higher price volatility, studies often show REITs tend to offer better risk-adjusted returns. There's a measure called the Sharpe ratio.
Sharpe ratio, right.
Right.
Heard of that.
It basically tells you how much of extra return you're getting for the amount of risk or volatility you're taking on. And historically, REITs often have a higher Sharpe ratio, suggesting they've been more efficient at generating returns for the risk involved compared to direct property.
So REITs give you liquidity, diversification. Direct property gives you control, a tangible asset. Sounds like maybe doing both makes sense for a lot of investors.
Precisely. Combining REITs and direct property in a portfolio, that's a very common strategy. It lets you try and get the best of both worlds, potentially optimizing that risk-adjusted return.
Now, you've hit on diversification a few times. Can you unpack that a bit more? Why is diversifying within real estate itself so important?
Yeah, it's really a cornerstone of managing risk, and it has several big benefits. First, as we just touched on with REITs, it reduces overall risk. Real estate, especially when spread across different types and places, doesn't always move in perfect lockstep with stocks or bonds.
Low correlation, they call it.
Exactly. So when the stock market tanks, your diversified real estate might hold up better, smoothing out your overall portfolio performance.
So it's about not having all your eggs in one property basket, or even one city's basket.
Right. And that diversification can also lead to better risk-adjusted returns over time. Studies show portfolios with a good mix, residential, commercial, industrial, maybe even some international property, tend to do better than ones just focused on, say, only local apartments. You're smoothing out the bumps.
Makes sense for overall returns. What about the income side? Does diversification help there too?
It does. It gives you more stable income, more diversified cash flow. Different property types have different rent cycles, different income levels. Residential might be steady. Commercial could offer higher yields, but be more sensitive to the economy. A mix helps keep the overall income stream more reliable.
In real estate is often called an inflation hedge, right? Does diversifying help with that?
It certainly strengthens that hedge. Rents and property values tend to rise with inflation generally. By diversifying across sectors and locations, you protect your purchasing power even better. Different markets might react slightly differently to inflation, so being broad gives you more resilience.
So it's about building a portfolio that can handle different economic weather patterns, different market shifts.
Exactly. Diversifying geographically exposes you to different local economies, different rules, different population trends. You can tap into growth areas while reducing reliance on just one place.
Okay.
Same with diversifying property type, residential, retail, industrial, healthcare, etc. It cushions you if one specific sector hits a rough patch. And finally, like we said, mixing liquid things like REITs with illiquid direct holdings, that gives you flexibility within your real estate allocation.
So diversification isn't just spreading bets. It's a really strategic way to build a stronger, potentially better performing portfolio by managing different kinds of risk. Okay, expectation check time. Looking ahead to 2025, what kind of returns should investors realistically be thinking about?
Yeah, managing expectations is key. For REITs in 2025, analysts are generally forecasting total returns around 9.5%. That's pretty close to their long-term historical average, actually, which is around 10%.
Okay, solid. What about income from REITs?
Dividend yields are currently sitting in the range of about 3.9% to 4.25%, so a decent passive income stream there. And it's worth noting some REIT sectors look stronger than others. Healthcare is mentioned, and especially data centers. The whole AI boom is really driving demand there.
Right, data centers are hot. And the advantages of REITs we know, liquidity, diversification.
Exactly. Passive investing, mostly.
What about direct property? What are the return expectations there for 2025?
For direct ownership, the general expectation for property value appreciation is around 3% for 2025.
Just 3% appreciation.
On average, yeah. But the bigger piece is often the rental income. Average yields there are often cited around 8.6% annually. Some investors use that rough 1% rule, aiming for monthly rent to be about 1% of the property value.
Okay, so 8.6% yield plus 3% appreciation.
Right, so when you combine potential rent income with that appreciation, maybe add value through smart upgrades, the total return potential for direct property could realistically be somewhere in the 8% to 11% range for 2025. Plus, you get the control, potential tax benefits, though it takes more active work.
So the total return numbers look kind of similar, maybe 8-11% for direct, 9.5% for REITs. But how you get those returns is quite different. Dividends and price changes for REITs, rent, and slower appreciation for direct.
Exactly. Long-term, REITs have averaged maybe 8-10%, often beating direct property on that risk-adjusted basis because of liquidity and diversification. But direct property returns can vary a lot depending on location, management, property type. The choice really comes down to your own goals, how much capital you have, your risk tolerance, and how hands-on you want to be.
Really highlights that need to match the investment to your personal situation. Okay, before we wrap up, let's talk about learning from others' experiences. What are the classic mistakes beginners make in real estate that people should really try to avoid?
Oh, there are definitely some common ones. Probably the biggest is just not doing enough research. Lack of understanding of the specific market they're jumping into.
Like what specifically?
Not looking into local trends, neighborhood quality, vacancy rates, the area's economic health. They just see a property and jump. That leads to buying in places with no growth potential or just plain overpaying. Due diligence is crucial.
So, homework first. Got it. What's another common trap?
Underestimating the costs and not doing proper financial planning. Beginners often overestimate how fast the profits will roll in and underestimate all the expenses: repairs, maintenance, management fees, taxes, insurance, vacancy periods.
Right, it's not just the mortgage payment.
Not even close. A shaky budget or too much debt can kill your cash flow and put the whole investment at risk very quickly.
Makes sense. What else?
Overpaying because of emotion, falling in love with a place and ignoring red flags, or agreeing to a price the numbers just don't support. And tied to that, neglecting location.
Location. Still true.
Absolutely.
Yeah.
Ignoring neighborhood safety, schools, shops, transport, future development plans, that kills rental demand and long-term value. You have to think objectively about how desirable that spot really is.
So keep emotions in check. Focus on location fundamentals. What about the overall plan?
Yeah, a lot of beginners lack a clear strategy or long-term plan. What's the goal? Cash flow. Appreciation. How long do you plan to hold it? What's your exit strategy? Without clear answers, you ended up making random decisions, missing better opportunities. Real estate takes patience and a plan.
And the practical day-to-day landlord stuff. Common mistakes there.
Poor tenant screening, that's a big one. Not vetting tenants properly leads to late rent, unpaid rent, property damage, evictions. It's a nightmare. And related to that is just ineffective property management overall. Not being proactive, not being professional, it eats into your returns and ramps up your stress levels.
Sounds like getting help or advice could be important.
Definitely. Another mistake is inadequate networking or not seeking mentorship, trying to figure it all out alone. You miss out on valuable knowledge, potential deals, best practices from people who've already made the mistakes.
What about fixing places up? Renovation mistakes?
Oh, yeah. Rushing renovations without a clear budget or knowing what renters or buyers in that specific market actually want. Not all upgrades pay off. You need to be smart about where you spend money.
Right, don't over-improve for the neighborhood.
Exactly. And then there's over-leveraging, taking on too much debt, or making bad financing choices, like high-interest loans without thinking about cash flow. That really increases your risk, especially if the market dips.
Okay, and finally, maybe a mindset mistake.
Unrealistic expectations, thinking it's a get-rich-quick scheme. Believing profits will be huge and effortless without understanding the work involved, the time it takes. That leads to disappointment and bad decisions. Building wealth in real estate is usually a long game.
That's a fantastic list of pitfalls to watch out for. Really valuable for anyone starting out. Okay, as we bring this deep dive towards a close, let's look even further ahead. What are some of those emerging frontiers, the cutting edge stuff in real estate investment, that are worth keeping an eye on?
Yeah, the space is definitely innovating fast. One really interesting area is blockchain-powered real estate tokenization.
Tokenization, explain that a bit.
Basically, using blockchain technology to turn ownership rights in a physical property into digital tokens. You can then trade these tokens. It allows for fractional ownership, owning just a small piece with much lower minimums, maybe $1,000 or even less.
So it makes owning bits of big properties easier.
Potentially, yeah. It could make real estate much more liquid, easier to buy and sell pieces, and open it up to global investors more easily.
Interesting. What else is out there on the frontier?
Well, there's Metaverse virtual real estate. People and companies are buying and developing digital land on platforms like Decentraland or Sandbox. They're making money from virtual rentals, hosting events, virtual art galleries.
Virtual land.
Yeah.
Wow. Still feels a bit Wild West, though.
It's definitely early days, lots of unknowns. But it's a fascinating new potential asset class to watch.
Okay. What about more established tech like AI? How's that changing real estate investment?
AI is becoming huge in optimized portfolio management. Algorithms are crunching massive amounts of data to predict rents with scary accuracy, rebalance portfolios automatically, even predict when maintenance is needed to cut costs. It's making investment potentially much more data-driven and efficient.
Using AI for smarter decisions. Makes sense. What about new ways of living together? Any investment angles there?
Yeah, co-living investment communities are interesting. These are properties designed to help residents who are often investors themselves collaborate, share deal ideas, maybe access shared tools or educational programs. The idea is it builds community, boosts retention, and maybe allows for premium rents.
So investing in the community aspect itself. What about the actual buildings being built? Any new models there?
Build to rent, or BTR, is a big one, especially in the US but spreading. Large-scale development of single-family homes specifically built to be rented out, often done by big players, maybe partnering with REITs, sometimes with features like climate-friendly designs.
Okay, purpose-built rental communities.
Yeah.
And with sustainability being such a focus globally, are there green real estate investment opportunities?
Definitely. Sustainable real estate funds are growing. They focus on buildings with green certifications, which often fetch higher resale prices and have better occupancy. We're seeing things like green bonds used to fund eco-friendly upgrades, even exploring ways to make money from carbon credits generated by green buildings.
So investing specifically in environmentally friendly properties. Seems like tech and social good are converging in many of these. What's the last frontier you wanted to mention?
Just the expansion of crowdfunding for niche asset classes. Platforms are now letting individual investors get into more specialized property types that used to be hard to access, things like medical office buildings, vertical farms, data centers, often offering potentially higher yields and diversification away from traditional real estate.
It's truly incredible how broad and dynamic real estate investment has become. From really focusing on social impact investing right through to these really cutting-edge technologies and niche assets. It's clear there's a lot for investors to think about in 2025.
Absolutely. And as we've talked through, getting those fundamentals right, understanding risk and return, avoiding those common beginner mistakes, that's absolutely essential for navigating it all successfully.
And this deep dive, it really was designed to give you, the the learner a clearer, more informed starting point as you think about your own journey in real estate.
Exactly. So, with all these insights into the trends and the core principles, maybe take a moment to think which of these areas really resonates with your vision, your goals for building wealth, maybe impacting your community, the landscape. It's definitely full of opportunity in 2025 for people who approach it with knowledge and real intention. So, the question really is, what's your next step going to be?
Yeah, maybe you're now really curious about tokenization, or perhaps that build-to-rent model caught your eye. What other questions has this sparked for you about property investment? Because remember, in real estate, there's always more to learn and explore.
Why did the new investor throw a party after buying a duplex without a loan? Because now he's house hacking happiness, and the bank didn't even get invited. And that's a wrap on today's episode of the Overflow podcast, all about jumping into real estate investing without using loans. Whether you're bootstrapping your first deal, getting creative with financing, or just starting your journey one cash deal at a time, remember, hustle beats high interest rates any day. If you found this episode helpful, or at least mildly entertaining, smiling face with open mouth and smiling eyes, don't forget to like, comment, share, and subscribe. It helps us reach more future investors like you. Got questions or your own no-loan success story? Drop it in the comments or hit us up on social. Until next time, keep learning, keep grinding, and as always, invest smart, even if it's one brick at a time.